Hello everyone and welcome to my channel, Your Everyday Economics. Today I will explain to you some of the most widely used macroeconomic terms relating to a country's economic performance. These are the terms we often read in the news, so we need to understand what they are and how they affect us. Even though my list is not comprehensive, but I feel it's a good start. In my future videos on economic glossary, I will be explaining the meaning of some other economic terms. The first one is interest rate. It is the cost of borrowing money or the return we get from saving our money in a savings account in a bank. By changing interest rates, the central bank can influence economic growth. Low interest rate encourage spending and investments and make the economy grow. On the other hand, rising interest rate makes loan more expensive and lowers investment. This reduces firms' hiring, employment, and thus the total demand in the economy can lower both inflation and the GDP growth. Another very important term to know is GDP. This measures the size of the economy. It is the market value of all the final goods and services produced in a country, whether it's made by the citizens, the companies, or by the rest of the world, but it has to be within the domestic boundaries. Market value is how much we pay for something, such as the market price for the bread that we eat or the plumbing service that we get. The US GDP number is published every quarter to see its trend. Economists at the Bureau of Economic Analysis estimate GDP by using data gathered by federal agencies and private data collectors. As of quarter 4 to 2022, the total GDP in the US was 20.2 trillion when measured by real GDP. The next is GDP per capita. It is an indicator of how well the economy citizens are doing. So this is by dividing the GDP number by the population. GDP growth is another important measure to look at because it compares the previous quarter or the previous year performance. So it could be a positive or a negative number depending on whether it was a growing GDP or a contracting GDP. I will talk more about GDP in a separate video, so stay tuned for that. Next is inflation, which is very important right now. And this is a sustained rise in the overall prices of a country, and it is measured over a period of a time. Usually, you compare it by previous month or compared to the previous year. So inflation reduces the purchasing power, and as you can see in my other videos, supply and demand both affect inflation. In the US, BLS is the authority and it publishes inflation number every month. They use CPI and PCE both to measure inflation. Sometimes the CPI can give us misleading information because it includes food and energy prices. These numbers are usually more volatile. The core inflation rate excludes food and energy prices and thus is a better measure of inflation rate. The Personal Consumption Expenditure Price Index is another measure of inflation. It includes more business goods and services than the CPI does. For example, healthcare services paid for by health insurance companies are part of PCE and not CPI. Another important term to know is unemployment rate. Every country sets a target unemployment rate that it seeks to achieve. In most advanced economies, it is a lower percentage compared to developing countries. In the US, the BLS publishes this percentage every month and the Fed tries to keep the unemployment rate around 4%. The unemployment rate represents the number of unemployed people as a percentage of the total labor force. People in labor force would include anyone over 16 years of age who are either employed or unemployed. So by unemployed, we mean someone who has looked for a job in past 4 weeks and haven't found one. As of February 2023, the unemployment rate in the United States was 3.6%. Next up is recession. A recession is a significant fall in the economic activity of a country. It is mostly seen as a decrease in the income and employment. During a recession, there's a significant drop in consumer spending. Some businesses can go bankrupt. People out of school don't find good jobs, and people might lose their homes when housing prices fall. If you want to know the exact definition of a recession, you can check out this source here. Next is monetary policy or the Fed. The Fed or the central bank of the US performs many important functions such as supervising the nation's commercial banks, conducting monetary policy, and providing financial services to the United States government. It also promotes the financial system stability by taking measures to prevent crises like recession and bank failures. The Fed is not just one bank but consists of three main components. The first one is 7 boards of governors. They guide the entire monetary policy and set the discount rate for member banks. Next is 12 regional banks. So these are the federal banks located in Atlanta, Boston, Chicago, Cleveland, Dallas, Kansas City, Minneapolis, New York, Philadelphia, Richmond, St. Louis, and San Francisco. And third is FOMC. This is the Federal Open Market Committee. It meets 8 times a year and makes decisions that help promote the health of the US economy and the stability of the US financial system. So the Fed is an independent entity and is not affected by the US politics. Congress has given Fed a dual mandate of stable inflation and maximum employment. The Fed tries to keep the prices stable with a long-term 2% inflation target and also promotes maximum employment. I have several videos on inflation and Fed's role in controlling inflation, so you can check those out here. Next is fiscal policy. Fiscal policy is the term used to describe the spending and taxation of a country's government that can influence the economy. For example, the government can lower taxes and raise spending to boost the economy when needed. Similarly, governments often spend on infrastructure projects to create jobs and grow income to take the economy out of a recession. Similarly, the Fed increases business investment and spending by lowering interest rates. In a boom situation, when the economy is overheating with high inflation and very low unemployment rate, they do the opposite. The government can reduce its spending and raise the taxes. Alternatively, or in addition, the Fed would raise the federal funds rate, which in turn will increase all the other interest rates in an economy and thereby puts a brake on the overall economic activity. Thus, either fiscal or monetary policy or both can be used to expand or contract the economy. If you found today's video useful, please like it. Also subscribe to my channel so that it can grow. Thank you for watching and I will see you soon in my next video. Bye.